Good morning, grade 11 learners. This session is for economics, grade 11. And today we are specifically going to look at the long and the short run costs. It's a paper 2's work that we are going to have a look at. We're going to start with the short run costs, and then later we'll look at the long run costs. Right, I would like to start with today's topic, and I want you to watch your screen so that you can follow and have a deeper understanding of the concept of short run and long run costs. Okay, this is what I'm going to do. It's part of microeconomics topics. Remember, under microeconomics, we've got perfect markets, we've got imperfect markets, and market failure. Now, what we are looking at now, it's part of the dynamics of the markets. It's a subtopic of microeconomics. It's for grade 11. So what we are basically going to look at, we are going to look at the effects of these short run and long run costs on the prices and the levels of production in a business. If we have time, we might also look at some revenues at a later stage, but it is not actually part of this session. This session only covers costs, both in the short run and in the long run. Now, let's look at what short-run costs are. But before we explain what short-run costs are, I would like to ask you a question. What are the objectives of a business? Why do businesses exist? Okay, the business exists for the following reason. Reason number one, a business is there in order to maximize profit. And for the business to maximize profit, the business must make sure that it keeps its production cost at a very low level. So that's one objective of the business. The second objective of the business exists because it aims at maximizing the sales revenue. Every business would like to see its sales revenue being maximized. And you know, the word to maximize is actually to get as much as possible. This is done through the efforts aimed at encouraging more consumers to buy the product. Right. So that's the only way for a business to maximize its revenue or to increase its revenue. It has got to encourage more consumers to buy their product. They can do that through advertising and any other means that will make more people to buy the product of the business. Another objective of the business it is to set targets for the growth in the target market. You know, every business has got a target market that it serves. Now, if a business starts by targeting, let's say, just for argument's sake, about 10,000 consumers within a specific target market, the aim of the business should be, in the long run, to increase its market share within that market. So that is what the business must do. They must set targets for the growth of the business within their target market so they can have a bigger market share within the market. So they need to do this by looking at their prices. If the prices are high, then they must lower the prices, because if you lower the prices, then you are encouraging more consumers to come and buy your product. They must also do another thing, which is to improve the marketing campaign of the business, so that the campaign can reach a wider number of consumers. Or alternatively, they can even look at lowering the marketing expenses of the business, because every marketing campaign or every marketing it has got its own budget. So the more money you spend on your marketing campaign, the more expenses is for the business. So when you try to lower the marketing campaign, you are increasing the revenue of the business. So these are the objectives of the business. But now, for any business to make maximum profit, which is the first objective there according to these objectives, to maximize profit. Now, for any business to maximize its profit, the business will have to manage its costs and revenue properly. We'll look at that later. So profit maximization, what it actually means, making as much profit as possible. If you make a profit of about in a micro enterprise, you make a profit of about 250,000 per annum. You cannot be satisfied by that profit. Your aim should be to maximize that profit from 250,000 to at least 300,000 per annum. So that should be the aim of each business. You're not just there to become stagnant in business. You are there to increase your market share. You are there to grow your market share, and you are also there to improve your revenue so that you can make more money. Because the more money you make, the more wealth you accumulate for yourself and for your family members. So that's why people are running businesses today. Okay, now enough with that. Let's continue. Now, when we talk about the word profit, we cannot talk about the word profit without considering the costs and the revenue. So when we have to explain what profit is, we say profit is the difference between the revenue that the business is making and the costs that the business is incurring. You know, there are expenses that the business will be paying, and when the business sell its product, then the business will be receiving some money. We call that revenue. So that's why I've taken some efforts to explain also the concept revenue. Revenue here we say is the amount of income that the business makes from selling its products or its goods or services. So whatever you receive after selling a service, it's referred to as revenue in economics. Now, in order for a business to maximize the profit, the business must produce or it must sell at a level where the cost of production is very low. Very, very important. Why are we looking at the short run and long run costs today? Because we also want to educate those who intend to go into business, that the cost of a business must be reduced in order for the revenue of the businesses to be increased, so that your profit would be much higher. So when we talk about profit maximization, which is one of the objectives of a business, this profit maximization, it happens where there is a positive difference between the total revenue and the total cost, or where the difference, where the positive difference must be the greatest. Then we're saying the business is maximizing profit. So what are we doing in order to look at the profit maximization situation in a business? We are looking at the total revenue of the business. Remember, the word revenue is the income that the business receives after selling its product. And then the total cost consists of all those payments that the business will have to make, you know, like your electricity, your salaries and wages. Those are the cost of the business. Now, when we compare the two together, revenue and cost, when the difference between the two is positive, then we say the business is making a profit. But now, if that positive difference is the greatest, then we say the business is maximizing profit. Right. Okay, now you can also look at another approach of looking at a profit maximization situation in a business. The first one is this one of using the total revenue and the total cost. The TR stands for total revenue, and the total cost represented by an abbreviation TC. Another approach is when we use the marginal revenue and the marginal cost. Right. If the marginal revenue is equal to the marginal cost, then we saying at that point where the marginal revenue equals to the marginal cost, the business is maximizing profit. Now, what is marginal revenue? The marginal revenue is the increase of the total revenue that we obtain by selling one extra unit of the product. So when we sell the first product, we sell the second product, and then we compare the revenue of the first product and the revenue of the second product. If our second product was the last product that we sold, then that will give us the marginal revenue, the difference between the revenue of the first product and the revenue of the second product. So that's why we say the marginal revenue is the increase in total revenue that we obtain by selling one extra or one additional unit or one additional product of the business. Whereas the marginal cost, on the other hand, it is the additional or the extra cost that the business incurs by producing an extra product within its product or production line. So that is the difference between the marginal revenue and the marginal cost. I hope that becomes clear now. Now, the point that I want to raise now is that, those of you who are studying accounting as well as economics, you'll realize that there's a difference between how an accountant looks at the costs and the calculation of profit. It is different from the way an economist looks at it. They do not calculate the profit in the same manner, but they look at the profit differently, the calculation of profit differently. Now let's look at that quickly. Economists and accountants, they look differently at the concept of cost of production as well as the calculation of profit. They do it differently. When we look at it from the point of view of accountants, they take into consideration what we call explicit costs. Whereas economists, on the other hand, when they do the calculation of profit, they also consider, in addition to explicit costs, they also consider implicit costs. We will explain the difference between the two. Right. Let's continue to write. I'm just trying to get my stuff to work here. I don't know what has happened here. Right, yeah. Continuing with the subject, grade 11 learners. Now, this is what becomes important in a business. You need to know what explicit costs are and what implicit costs are. Starting with explicit costs. These are all expenses that a business has to pay for the use of the factors of production. You know that labor is a factor of production. You know that entrepreneurial skill, it's a factor of production. You know that raw materials, capital, those are factors of production. So for a business to operate, they'll have to pay, they'll have to remunerate those factors of production. So when we talk about explicit costs, we're referring to all those expenses that a business has to pay when they use the factors of production. Whereas implicit costs, they include an acceptable remuneration for the entrepreneur, the owner of the business. And it also includes the opportunity cost of the factors of production. You look at your entrepreneurial skill, or you look at your skill, which you could have used somewhere else, working for somebody else. But now you decide to use it for your own benefit by opening your own businesses or your own business. So that's the opportunity cost that we are talking about. If where you could have used your skill, you were going to earn an amount of about 50,000 per month, but then you decided to forego that and decide to open your own business. That 50,000 that you could have earned somewhere else when you use your skills, being employed by somebody else, it's the opportunity cost of of your business. So that is an example of an implicit cost. Right. Okay, let's continue to look at the profits. Now, in economics, later on, especially in grade 12, they are going to teach you the different types of profits, right? But the profit that, we talk about in our daily language, it's actually accounting profit, right? It's accounting profit. All businesses, when they calculate their profit, that profit, it's an accounting profit. So accounting profit is the difference between a business total revenue and its explicit costs. So this is according to an accountant's point of view. This is how they calculate profit. They take the revenue that the business is making and they subtract all the explicit costs, and then they will arrive at an accounting profit. So the total revenue, remember again, it's all the income that the business is receiving or it has received over a period of time. It can be a year, it can be a period of 6 months. It depends on the financial year of the business. But normally a financial year is about a period of 12 months. So when we look at the total revenue, we start from the first month of the operation of the business until the last month of the operation of the business. Then we calculate, we add all those costs. They will give us the total, we add all those income that the business has been receiving. So that will give us the total revenue. This mainly includes income from selling the product. When the business sells its product, they receive an income. Or when they render a service, it can be, a business that, for instance, that sell, chesanyama, whatever you receive from your chesanyama when people buy, that is part of your revenue. Then explicit costs, we have explained what explicit costs are. They are linked to business operation. They are directly linked to business operation. And they would include payment of wages to those who are working for you. Those who will be buying there, you will pay them, and that is known as wages. And it also includes payment of materials, whatever you'll be using. You have to buy meat, you have to buy charcoal, and all those things. That is material. And sometimes you buy stock on credit, so you have to pay your creditors. That's one of your expenses. And the transportation of material from the abattoir to your chesanyama, transportation cost. The administration, every business has got to have its own administration. Somebody who keeps the record, somebody who, who makes sure that enough stock is available, all those sort of things. As well as the equipment, be your cash registers or whatever, your point of sales, facilities, etc., as well as the building from where you are operating. So those are the total expenses of the business, and they are known as explicit costs, the payments that the business will have to make on using factors of production. Okay, now when we look at how economists calculate their profit, we said it is different from how accountants calculate it. Remember, with accountants, they take the total revenue of the business, and from the total revenue they subtract all explicit costs. They don't include implicit costs here. Now with economists, using the same approach of total revenue minus explicit cost, this is the approach that is used by the accountant. It is part of what economists are doing. The only difference is that with economists, they include also implicit cost, the amount that is involved in implicit cost. So that is the cost of being self-employed, because remember, with your skill, you could have offered your skill to a certain employer and get paid, but now you have decided to run your own business with your very own skill. So the amount of salary or wage that you have decided to sacrifice, that where you could have earned it, it's your opportunity cost. So that's why we're saying here it is the cost of being self-employed. For example, if you didn't run your own business, you could have earned an amount of 50,000, which then represents the opportunity cost of being self-employed. So this is how economists calculate profit. And by the way, with economists, we don't call it accounting profit. It's only for the accountants where we call it accounting profit. With economists, they call it economic profit. So they say, this is the approach of economists. They say the total revenue of the business minus explicit costs, in brackets, explicit costs plus implicit costs. So they add implicit costs as well as explicit costs together, and then they subtract that amount from the total revenue. Then they will get their profit. It may be an economic profit. With economists, they've got different types of profit. The first one is economic profit. It's when there is a positive difference between the total revenue and the total cost. And there's another one, they call it the normal profit. The normal profit is when the profit that the business is making is zero. If you subtract your total cost from your total revenue and you get a zero as your answer, that is normal profit according to economists. But economic profit is when you get a positive difference. You know, if you've spent something like, let's say for argument's sake, you've spent 50 cents to buy one lollipop, and then you sell it at 1 rand, right? Your cost is 50 cents, but your selling price is 1 rand. The difference between the two, so your revenue is 1 rand, your cost will be 50 cents. So when you subtract your cost from your revenue, you get a profit of 50 cents. So that's an example of an accounting profit, of an economic profit, which is positive. The difference between the total revenue and the total cost. When it is positive, is known as economic profit according to economics. Right, so remember the difference in the calculation of profit. Look at the first one, accounting profit. You get it by subtracting from the revenue the explicit costs. And then economic profit, you get it by subtracting from the revenue both explicit and implicit costs. I hope that is now clear. Now, coming to the real topic, what's the difference between the short and the long run? Because remember, our topic is highlighted there in blue. It's short run cost. But I'm going to do both short run and long run cost. Now, what is the difference between the two? The short run cost, firstly, we are looking at a period short run as well as a period long run. What's the difference between the two periods? Okay. Firstly, when we talk about the short run, sometimes we use another term as short term. So short run is the same as the short term. So this is a period that is so short. I think it's a period that lasts for something like 2 to 3 years. So that period is so short that some of the factors of production that are used in the business or other inputs, they will remain fixed in the short term. So in the short term, we say at least one of the factors or one of the inputs that are used in the business must remain fixed. For example, paying rental. You're paying rental to a building. So a building is a factor of production referred to as capital. It will be fixed in the short term. So that's why we say in the short term or in the short run period, at least one of the factors of production or one of the factor inputs in the business is fixed. So that is what differentiates the short run to the long run. When you look at the long run, in the long run period, all factors of production, all factor inputs are variable. There's no one that is fixed. You only get a fixed factor of production under the short run period. But in the long run period, all those factors are variable. They are allowed to vary. You can change them at any time. But in the short run, at least one of them is fixed. So that's the difference between the short run and the long run. You must remember that one. Please don't forget it. And then these are the short run costs that are found in any business, right? Firstly, you have a combination or a summed up figure of all the costs in the business. We call that the total cost. We say it refers to the total cost of production of the business. As a firm has variable cost, those costs that changes, and those that are fixed within the short run period. So the total cost of a firm is the sum total of the fixed cost, which can also be referred to as the total fixed cost, and the total variable cost, or the TVC. So that is our formula there on the screen. Your TC there is equals to your TFC, which is total fixed cost, plus your total variable cost. We don't mind, you can just leave them as fixed cost, FC plus VC. We will understand it's fixed cost plus variable cost. The two together, they give you the TC, which is the total cost. We'll look at some of the examples later on. So what are fixed costs? Now, let's understand, when we talk about fixed costs, remember, you can only have a factor that is fixed in the short run period. So your fixed costs are costs which remain the same. Even when you decide to change the number of the goods that you are producing, your fixed cost will remain the same. So fixed costs, they include lease payments on equipment. If you have hired an equipment, say for 6 months, every month you'll have to pay a certain amount for that equipment or for that machinery. Or rental payment on a building that you are hiring. Or sometimes you will hire a vehicle, you'll have to pay on a monthly basis. That would be an example of a fixed cost. And some of your equipment, some of your assets in a business, you have taken an insurance cover, and you have been given a premium that you need to pay monthly, and that premium is the same. At least for 12 months, you'll pay the same amount. We say it is fixed. It's an example of a fixed cost. So whether you are producing or you are not producing, you still have to pay rental on the building. You still have to pay insurance for the assets that you have covered under your insurance. So those are the fixed costs. They do not go with the change in production. So whether you produce or you don't produce, you still have to pay your fixed cost. But let's look at variable costs on the other hand. These are the costs that that can change when the number of items that are produced changes. We call them variable costs. So there are costs which change with the number of units that are produced. So variable costs, they include costs such as paying wages for labor, paying your electricity bill, paying for other resources in the business like your raw materials. If you decide to increase the number of goods that you are producing, then it means you have to buy more raw materials, it means you have to pay more. So these costs, they are dependent on the number of goods that you are going to produce. Right, so that's the difference between fixed cost and variable cost. And then we have another type of costs. We call them average costs or average total cost, AV, or you can use the abbreviation ATC, but we are fine with AV. So these are how to obtain this average cost. You need to have your total cost first. So from your total cost, when you take that figure of your total cost and divide it by the number of units produced, it will give you the average cost or the average total cost. As you can see in this formula here, we have the formula here, average cost is equals to your total cost, which is your total cost, remember, is the sum of fixed cost and variable cost. So you'll be taking your total cost and then you divide it by the number. Q there stands for the number of units produced, the quantity produced. You'll be dividing the total cost by the quantity produced, and then you will arrive at your average cost of your business. And we are using this average cost to make a decision whether we must continue as a business or whether we need to consider to shut down the business, because it will give us a pretty good idea of how the business is doing. Because the minute the average costs are lower than the price that we are charging or the revenue that we are receiving, then the business must start to consider structuring its operation, or if not, then they will have to close down. Right, the average cost also has got two types of costs. Firstly, we have the average variable cost. Remember what are variable costs? They are the cost that changes with the change in production. They change with the number of goods that we produce. And then fixed costs, they don't change, they remain the same, they don't depend on the number of items that we produce. So we have average variable cost, and then we have average fixed cost. Now, AVC, or average variable cost, it's when you take the variable cost and then you divide it by the number of units that you are producing, as you can see in this formula here. AVC, average variable cost, is equals to variable cost divided by the quantity produced. Whereas the average fixed cost, AFC, it's fixed cost divided by the number of units produced. Here's the formula. AFC is equals to FC divided by Q, which is the number of units produced. Right. So these are the short run costs that you find in any business. I would like to take a few minutes break, and then we'll come back and look at other concepts related to short run costs. Thank you. Welcome back. Our topic today, we are looking at the short run costs. Later on, of course, we'll look at the long run costs. Now, just a summary of what we have done so far. We have looked at the different short run costs that the business will have to pay. And there are two types of those costs. We've got variable costs, are those costs that changes with the change in production. And then there are those costs that remain fixed. They do not depend on the change in the number of goods that we produce. They remain the same. And then we have also differentiated between the short run period and the long run period. We said the short run period is a period that is so short and where at least one of the factors of production, or where at least one of the inputs in the business is fixed. That's a short run period. And then the long run period it's a period that is too long, where all the factors of production that the business uses are variable, which means they change, they keep on changing depending on the number of goods that we produce. When we produce more, it means we spend more on materials that we use to produce. So that will, that's why we call them variable costs, because they will change when there is a change in the number of units that we produce. Whereas fixed costs remain fixed when even when we do not produce, we're still paying our fixed costs. And we've looked at different examples of fixed costs, like the rent on the building that the business is hiring, the insurance premium. Those are just example of fixed costs. And then example of variable cost, when you pay your labor's wage, when you pay for materials that you use in the production of goods and services, when you pay for water and electricity, those variable costs, they change as the production changes, right? And then we've also looked at, the two approaches of calculating profit, right? There is an accountant's way of calculating profit, which is total revenue minus explicit costs. That will give you an accounting profit. That's according to accountant's calculation. Whereas according to economists, this is how they calculate their economic profit. We call it economic profit. Say total revenue subtract explicit cost plus implicit cost. Then they will get what we refer to as economic profit. Okay, we have looked at, you must be able to explain what is revenue, what is total cost, because for you to calculate profit, you need to know the total cost, which is the sum of all the costs in the business, right? And then you also need to know the total revenue of the business, meaning all the income that the business receives for selling their items and many other activities that gives them an income. So from that total revenue, we'll subtract total cost, and then that will give us a profit. So whether we are calculating an accounting profit or an economic profit, the question will be specific. Right, now let's look at this example quickly on the screen. I want you to do this as your class activity, but of course I think I will help you so that you understand how to apply these formulas. Now let's assume Peter is a mechanic and runs his own repair business from his garage. He has spent an amount of 50,000 to buy tools and equipment, and after a year his total revenue is 230,000 after a year of operation, and his explicit cost is given as 120,000. Peter could have earned an amount of 60,000 working for someone else. That's the opportunity cost. You must be able to identify this. This is the opportunity cost that I referred to earlier. By putting the 50,000 in a savings account, which 50,000 is that? The 50,000 that Peter started the business with. We call that capital, his capital. He could have saved that capital, he could have put it in a savings account where he could have earned an interest of about 5,000. By renting his garage, Peter could have earned 18,000. Right. Okay, now we have the scenario. Let's look at the question. The question says, the first question says, use the above information to calculate the profits according to an accountant's calculation. Now you know that an accountant needs the total revenue as well as explicit cost so that they can calculate an accounting profit. Okay, now let's look at that quickly. This is how the accountant will calculate the accounting profit. What is the total profit? It's given as 230,000. Let's go back again and just verify. Can you see that? The total revenue is given as 230,000. There it is. So now we need explicit cost. So we have our total revenue, which is 230,000, and then we need explicit cost. Our explicit cost is 120,000. Let's go back just to confirm again. There it is given, and his explicit cost is 120,000. Okay, now we have those two. We have total revenue of 230,000, then we minus explicit cost, which is 120,000, and then our profit, which is accounting profit, will be 110,000. See, this is how an accountant will calculate his profit. The second question, let's go back to the question again. The second question says, use the above information to calculate implicit cost. Now, implicit cost is the amount that could have been earned somewhere else. If you could have used, as let's say for the garage, it says here, Peter could have used his garage. He could have, hired his garage out and earn an amount of 18,000. Peter could have deposited his 50,000 in a savings account and earn an amount of 5,000. And he could have also used his skill by working for somebody else and earn an amount of 60,000. Those are implicit costs. Now, let's do the calculation again of implicit cost. So we're going to calculate all our implicit costs. Let's see. So this is how we calculate implicit costs. We look at all the opportunity costs. Like this one, for instance. This is the 50,000 that Peter, put as a startup in his business. That is his capital. He could have saved that and earn an amount of 5,000 in a savings account. So we take that one, and then we look at the second one. This is his garage, because he's operating his business in his garage. He could have rented out his garage and earn an amount of 18,000. There it is there. That's the opportunity cost of the garage. And then he could have worked for somebody else and earn an amount of 60,000. We take that into consideration. So we add all these opportunity costs of the capital that was invested in a business, of the garage that is used for the business, as well as the skill or the capital that Peter, the salary that he could have earned by working for somebody else. So when we add all this together, we'll arrive at an amount of 83,000 rand. So this is the total of our implicit cost. Very easy to calculate. Now the last question, if we've got to go back there and look at the last question, it says use the information above. Use the information about the explicit and implicit cost to determine the profits according to an economist's calculation. In number one, we calculated the profit according to an accountant's calculation. Number three, we are going to do the calculation according to an economist's calculation, which means we are going to calculate economic profit here. Now let's look at that again. It should be very easy now. So this is how we go about it. We have our implicit cost, we have our explicit cost given already now. Now this is how economic profit will be calculated. We we say we get our total revenue is 230,000, and from the total revenue we subtract all our implicit cost as we've just calculated earlier. It is 83,000, and then remember we were given an amount of our explicit cost as 120,000. So this is how our economic profit is being calculated: total revenue minus explicit cost, minus implicit cost, and minus explicit cost. Or you can add the two costs together and then subtract the amount from the total revenue. So this is the amount that we will arrive at as our economic profit. You see, our economic profit is 27,000, you know, different from accounting profit. Accounting profit, it's a little bit higher than economic profit. See, that's the difference. Okay, fine. Now let's continue. I want us to continue. Here we've got what we call the short-run cost schedules. This is a schedule of all the costs that you find in a business. The very first column, it's a column of all the units that are produced from 0 to 8. You can see that, ne? The output column. So you can see, even if we are not producing, the second column we have fixed costs. So even if we are producing nothing, we still have to pay fixed cost. Why is it 40 all the way? Because it remains fixed. It remains fixed. These fixed costs, they remain fixed. And then we've got the next column for the variable cost, or TVC, total variable cost. These costs, they change as production changes. For 0, we had no variable cost there. But when we started producing the first item, our variable cost increased to 15. When we produce the second item, our variable cost increased to 25. So every time we increase our production, our variable cost increases. Right. And then the next column, column number 4, it's our total cost. How do we arrive at a figure of this total cost? Of course, it's indicated here. You add your fixed cost and your variable cost to get your total cost. For example, this 40, where does it come from? It's your variable cost, which is 0, plus your 40, which is your total fixed cost. It gives you this amount. And then the next column, the next two columns, it's your average cost. Firstly, we have the average fixed cost, which we calculate by dividing the fixed cost. Where's the fixed cost? This one. We divide it by the Q. Right. So the reason why we don't have anything there is because what is our fixed cost here? Our fixed cost is 40 when we are not producing anything. So we have to divide it by the quantity. What quantity are we producing? We are producing 0. So any number divided by 0, I think in mathematics you say it's undefined. That's why we have nothing there. And then the next column is variable cost. Here, this one. How do we calculate variable cost? We take the total variable cost, and then we divide it by Q to get average variable cost. So the reason again why we don't have anything here is because we don't have anything for variable cost, and we don't have anything for output. So that's why we have nothing there. Then the next column, it's the average cost, or average total cost. How do we get that one? There are two approaches of getting it. This ATC or AC. We can get this one by adding the two together. We can add 40 at quantity 1. We add 40 and 15 to give us average total cost. That's one way of calculating it. The another way of calculating it, we look at the total cost and then we divide it by output. Let's look at the when we are producing the first item. The total cost is 55 there. And according to the formula, the 55 we must divide it by quantity. What is the quantity at 55? Total cost is 1. So when you divide 55 by 1, it gives you 55. So these are the two approaches of calculating the average total cost, or the just average cost. And then lastly, on the right is our marginal cost. We haven't spoken about marginal cost, but I remember us defining it earlier in our presentation. We said marginal cost is the extra cost that the business incurs for producing one extra unit. Right. So this is the formula that we use to calculate the marginal cost. It is the, you see the small triangle there, it's not actually a triangle, we call it delta. Delta means change. So for us to calculate marginal cost, we take the total cost, we say it's change in total cost divided by a change in output. Right. For 0 units produced, we have nothing there. But let's look at this one. It's what we call the marginal cost for the first item that we are producing there. Number 1, what is our total cost? Our total cost there is 55. Are we together? Do we understand each other? It's 55, that's right. And then we have to divide that by the quantity. Right, we have to divide it by the quantity according to the formula there. So so for this one here, the marginal cost would be 15. Right. Let me calculate that for you. Okay, let me do that so that you have an understanding. It's your MC, which is your marginal cost, is equals to change in total cost divided by change in output. Right. Now, our output from 0, let me just go back there and show you. Our output changed from 0 to 1. Am I right? Because we did not produce anything here, but the next we produced 1. Right? So while we were not producing anything there, our total cost was 40. Right? And now that we produced this single item, our total cost is 55. So let's get the difference there. So this is how we get the difference. Let's start with change in total cost. Our total cost changed from when we were producing the first item, the total cost there is 55. Am I right? Right? We minus the total cost of the previous quantity that we produced was 0. At quantity 0, our total cost was 40. Am I right? Right. We divide this by the change in output. Right. Our change in output, how much are we producing now? At 55, how many items did we have we produced? Only 1. Minus at a total cost of 40, how many units did we produce? 0. Right. So when we do the calculation there, it would be 55 minus 40. It is the difference there is 15 divided by 1 minus 0. It is still 1. So that's why our MC there is 15 according to this table. Can you see? So the next one is 10. You calculate it in the same manner. Right. Now let me step off from this cost schedule and look at something different now. This all explains, how to calculate all those figures on the cost schedule. and I've indicated to you, you know, how do we calculate some of them, right? Like your total cost, you need to add your total fixed cost plus your total variable cost. You get, for instance, let's just go back again. For you to get total cost here of 40, you add 40 and 0, it gives you 40. The next one, you add 40 and 15, this is what you get, right? Okay, let's continue. Now, I just want to emphasize bullet number 3 here. The total variable cost, we say it changes with output. When the output changes, the variable cost or the TVC changes also. Now it says here at output number 2, your total variable cost is 25. And at output number 8, your total variable cost is 30. So let's see whether that is true according to this table. It says your total variable output changes with output. Let's see. When we were not producing anything, we had nothing for total variable cost. When we were producing the first item, we had 15. When we were producing 2, we had 25. When we are producing 8 units, we have 130. So it is true that the total variable cost changes with the output. Okay, so we are just verifying the statement. So in other words, because of that change, the total variable cost increased from the very first units that we produce. Now, firstly, it increases at a slow rate, right? And that concept of the total variable cost increasing at a slow rate, we refer to it as the law of diminishing marginal returns. This law of diminishing marginal returns, it says that when we employ more variable inputs, or when we employ more variable factors of production such as labor or electricity and water, it will increase the output initially at a small additional cost. But however, if the firm is only able to increase the use of variable input, these will contribute less and less to the total output and will therefore start costing more per unit. So this will see variable cost rise at a faster rate. Let's just go look at it again. It's this one. The difference here between 25 and 15. The difference there is 10, and then the difference between 25 and 30 there, it's only 5. Between this and 30 and 40, it's 10. Between 40 and this is 15. You see, that's why we say here it starts to increase at a slow rate, right? And then later on, it will increase the output, but at a small additional cost. So this will ultimately lead to an increase in the cost per unit for the business. And that's not what we want in a business. We don't want our cost per unit to increase because it will actually lead to a loss of the business. Right, I just wanted to emphasize that. The other stuff you'll do for yourself. As long as you know how to calculate the total revenue, how to calculate the average revenue, how to calculate the marginal cost. Right. Now, what I would like to focus on now is to plot the graphs, the cost graphs. We've looked at the schedule. This is the schedule. Now we need to look at the representation of this on a graph. Now I'm just going to plot one graph for you to show you how we plot these graphs. Okay, let's see. Yeah, I just want to show you that. The total cost, as you can see here, we say it increases as output increases. If you go back to the table and look at output 0, the total cost is 40. right? Now we're saying at that the business has to pay for its fixed cost, even if nothing is produced. And the output, at output number 7, the total cost is 140. At output number 7, where is output number 7? Here. The total cost is 140. Can you see that? So this total cost increases as we increase our units of production. Okay, that's one thing that you must know about total cost. Now we can use that table above there to calculate the average fixed cost, average variable cost, and average total cost, like I've shown you already how we do that. Now let's just say, for argument's sake here, going back to the table above, at output number 1, your average fixed cost is the highest, which is 40, but it decreases until it becomes 5, until it becomes 5 at output 8. Let's just go back and confirm. At output 8, it becomes, according to them, it becomes 5, the average fixed cost. Here it is. This is the highest. But as we continue to produce more and more, you see what happens to the average fixed cost. It's decreasing continuously. 40 to 20, from 20 to 13.3 to 10 to 8 to 6.7, 5.7, and ultimately it goes to 5. So when we continue to produce, our average fixed cost decreases. And how do we calculate this? We said it is fixed cost divided by quantity. Can we just make an example? Right, let's just make an example of this one here. Right, we say average fixed cost is equals to fixed cost divided by output. Right, now we know that at output 0, or let's say output 1, let's go back to the table again and look at, let's go back to the table here. At output 1, the average fixed cost is 40, right? At output 1, the average fixed cost is 40, because this is what happens. Going back to the table again, just to show you again. What was the fixed cost at output 1? The fixed cost was still 40. Remember, it doesn't change, right? Okay, can you see? It is 40. Now let's go back to our calculation. So at output 1, what is the fixed cost there? The fixed cost is 40. And what is the quantity there? The quantity is 1. So when we divide 40 by 1, it gives us 40. So that's how we calculate the average fixed cost. Okay. I think I've shown you how to calculate the average fixed cost. Now I want to show you how to calculate the average variable cost. The average variable cost, this is how we calculate it. Your average variable cost, look at the pattern first. The pattern is that your average variable cost, it first decreases and then it increases. For the first output, your average variable cost is 15. For the second output, it decreases to 12.5. And for the last output, it increases to 16.2. We call this the law of diminishing marginal return, like we stated it before. Now let's look at the pattern. Let's go back to the table and look at the pattern again. Here is the pattern. Average fixed cost. When we produced the first item there, we had 15. And then when we produced the second item, our average variable cost decreased to 12.5. When we produced the third one, it decreased to 10. When we produced the fourth item, it decreased again. It remained constant from between 3 and 4. And then when we increase to 5, it increases. And then when we produce the 6th item, it increased to 12.5. And then when we produce the 7th item, it went up again to 14.2. So it decreases, and then it remained constant for a while. It decreases from the first to the second, and then it remain constant here, and then it starts increasing again. So that is the what we can observe, what happens to the average variable cost. Now, let's look at the calculation of that. The calculation of the average variable cost. Calculation of the average variable cost, according to the information on the table, we say your average variable cost is equals to our variable cost divided by quantity. Now, again, let's look at from the table. Let's look at quantity number 2. Now, at quantity number 2, can you see? This is quantity number 2. Our average or our variable cost at quantity number 2, our variable cost is 25, right? It's 25. And then our output is, our output there is this one. At number 2, our output is 2, and then our variable cost is 25, right? So let's do the calculation quickly to show you how do we do it. So at output number 2, at number 2 output, our variable cost, our average variable cost is equal to, what is the variable cost there? The variable cost there is 25 divided by the quantity there is 2. So when you divide 25 by 2, this gives you 2.5. Let's go back to the table and confirm. So there it is there. Can you see? So that is how we calculate it. All right. Now I want us to move on to the plotting of, because I think I've already shown you how to calculate the marginal cost, right? I've shown you how to calculate the marginal cost. Remember, we were calculating the marginal cost at output 1. Let me just remind you, we calculated the marginal cost at output 1. Remember, this is what happened. At output 1, we had this one here. Before we produced the first item, we produced nothing. So at the new total cost, when we produced the first item, our total cost there was 55, right? Was when we produced the first item. But when we were not producing anything, what was the total cost? It was 40. So we subtract 40 from the new total cost, which is 55 minus 40. And then while we were producing one, here it is. And then we were not producing anything previously. So when we do the change here, it's 55 minus 40, 1 minus 0, and it gives us this 15 divided by 1. It's 15. So that's how we calculate our marginal cost. Now let's go back to the presentation and look at how to draw the cost curves. Right. Now the cost curve that I want to help you to draw, I'm just going to draw one for you, and then you'll be able to draw the rest. Right. I'm just going to draw, let's say I'm going to draw 2 of them. I'll start with the total fixed cost. Right. Let me go back to, okay, let's look at this one. Let me show you this table here. Can you see this table? Because I'm trying to plot those curves on the right. It is your total cost, which is this gray curve. This represents your total cost. And then this one here represents your total variable cost, whereas the blue line represents the total fixed cost. And here is the schedule given to you. Now, I just want to help you how to do the plotting. If you do not know how to plot the graphs, then I definitely want to show you how to plot the graphs. Right. Now let's look at this then. In your graph, you need to indicate your x's. You need to label your x's. This quantity, the Q, you indicate there that this is your output quantity, the x-axis. And then on your y-axis, we have indicated that it is our cost. Right. Now this is how you do the plotting of your curves. Remember what we said. This is the output from 1 up to 10. When we are not producing anything, what was our fixed cost? It is, in other words, when we are not producing anything, let me just do this here. When we are not producing anything, which means when our output is 0 here, how much was the fixed cost? It is 40. So where 40 and 0 meet, it's our first point. And then when we are producing, let's just go back. When we are producing the first item, what is our fixed cost? It's 40 all the way. Can you see that? It's 40 all the way. So it would be for 2, it would be 40. Do you see this? This is how we do our plotting. For the second one, it is still 40, right? So 40 and 2 meets here, and then 4, it's still 40. This is where the 2 meet, and then for this one they meet there, and then for 8 and 40, for 10 and 40. So after making these dots, then you join them by a straight line, and then this is your fixed cost, or TFC. All right, so this is how we do the plotting of the curves. Now let's go and plot the second one. I want us to plot the, let's say, this one, the variable cost. Let's look at the variable cost. The variable cost, when we are not producing anything, what is the variable cost? Is 0. Okay, so which means our graph will start at 0. Ne? Let's just do it quickly. When we are not producing anything, what is the variable cost? It is 0. So which means our curve is going to start here. Let's look at the next one. The next one is when we are producing, let's say number 2. When we are producing number 2 there, our variable cost is 25. When we are producing the second, it's 25. So for 2, we're going to look at 25. So our, this is 20, it's, so in between, this here would be 30. So in between 30 and 20, 25 would be somewhere here. Right, 25 would be somewhere here. So for the second item that we are producing, this the what you call the dot would be here. It's for 25 of the costs and then 2 of the output. The next one, let's look at 4. When we are producing the fourth unit, it's 4. What is the total variable cost? It's 40. So for 4, it's 40. We already have that point there. And then let's go and look at number 6. When we are producing number 6, the variable cost is 75. Now we need to go and locate 75 where it is on the graph. So this is 6, 75 from 60 is 70. 70, between 70 and 80, there's where you're having your 75. So let's put it right there. There's another dot for us there. And then the next one, let's say 8, and it's 8. Okay, I'm sorry. It's let me just go back and show you. For 6, it's 75. So this is 6 on your output. Your cost is 75 there. It's from 60, it's 70, and between 70 and 80, that's where you have your 75. So that's our next dot, right? And then for this one here, 8. When we are producing the 8th item, according to our schedule there, what is our total variable cost? It's 130, eh? It's 130. So where is our 130? So here we having 120, and our 130 would be between 140 and 120, somewhere here. So we're going to have our next dot somewhere here, right? And then after you've done that, then you join this. This would be your total variable cost. So this is how you do your how you plot your cost curves. Can you see that? Can you see this? This is how you plot your cost curve. Then you can do the rest. Remember, this information is so important. You're going to apply it in grade 12 when you do you know, when you do microeconomics, right? So let's continue. Before we continue, I think I would like to take a few minutes break, and when we come back, we'll continue to look at some of the cost curves that we have here. Okay, welcome back, grade 11 learners. And now on the screen here, what you see, we have plotted all the 3 curves there: the total fixed cost, the variable fixed cost, the variable cost. This is the fixed cost, the blue line there. And then this brownish line is for the variable cost, and then this is the fixed cost. Right, let's go to the next one. The next one, let's look at the average cost. This is how our average cost looks like. Remember, from this is now about the fixed. Remember our blue line of the fixed cost. It's a horizontal line. Now when you do the average fixed cost, it's going to look like this. Average fixed cost. You can confirm that by plotting it yourself. And then let's look at the average variable cost. We have average variable cost. We have which you get by dividing the variable cost by quantity, and then this side we have the average total cost. You get it by dividing the total cost by quantity, and then the marginal cost. We've done that one. Now this is how our average variable cost looks like. It is this graph here. Let me show you how it moves. It goes like this: the average variable cost. We use it to determine the shutdown point, you know, of a business. This curve, this particular curve here, the AVC, here it is. And then we have your average cost curve, or the ATC. Which one is it? It is this one, the grayish one. This is how it looks like, the AC curve. It moves like this. And then the last one, it's the MC curve. The MC curve normally cuts both the AVC and the AC curve from at their minimum point. You know, it comes from below the two curves. So these are the cost curves that I want I wanted you to know, because you will need this information next year in grade 12. Let's continue to summarize now. We've talked about all these things. Now I want to focus on the long run costs as our last session. Remember, we've made a distinction between long run period and short run period. What did we say? Short run period, it's a period under which at least one of the factors of production remain fixed. Whereas long run period, it's a period where all the factors of production are variable, or they vary. Okay, now let's talk about the long run costs. Now, we say a business has enough time over the long run or over the long term to do what? To buy larger factory, to change from a small factory building to a bigger factory firm, to buy more vehicles and more improved machinery and equipment. For example, over the long period, over the long run, a small business will be able to expand, because normally some of them in the short term, when they make a lot of revenue, they would want to expand their businesses for later. So they will expand their businesses to become larger businesses. Anyway, you don't plan to remain small business forever. Your business must expand over the long run. So that's a business concept that is acceptable. So the business can change all its inputs that it uses. Even those that were fixed in the short run, they will now change in the long run, especially when the business is considering to expand. So what is the long run? The long run is a period that is long enough to enable the business to change all of its costs, including fixed costs. Even those fixed costs that the business was paying, they are now going to become variable in the long run. Right. Now, when we talk about the long run costs, we need to consider the following important concepts. Right. Now, the first one, just before we go to the graph there, the first one, we need to explain what is economies of, what is scale of production. What is scale of production? Now, when we talk about scale of production, what happens normally in a business? It's when a business is increasing its production capacity to enable it to produce more. Right. So every time when you hear business analysts talking about scale of production, you must know that it's a situation where the business is increasing its production capacity to enable it to produce more. You cannot produce more in a small factory. You need to expand your factory building, the size of the factory, so that you can produce more. So we call that scale of production. And then secondly, the second concept related to long run cost, it's economies of scale. Now, what is economies of scale? What happens during when a business is experiencing economies of scale? You'll have all your average costs dropping as the cost will be divided over more units of output. So your average cost, that is your average variable cost and your average fixed cost, they will decrease. And why are they decreasing? It's because these costs are now divided over more units of output. They no longer, concentrated on one fixed cost, on one fixed item, but now they are spread over all the other inputs, which are now variable in the long run. So we call that economies of scale. The average costs are declining because these costs are now shared by more inputs. That we call that economies of scale. The last one, not the last one, but the penultimate one, diseconomies of scale. Diseconomies of scale. This one, it's where the average cost of the business is increasing as the contribution of the variable inputs becomes more expensive. Now, with diseconomies of scale, the business experiences diseconomies of scale when the average cost of the business are increasing. Why? Because the contribution of the variable inputs becomes more expensive now. Then we say the business is experiencing diseconomies of scale. And then we have this one we call constant returns to scale. This one the business experiences when it produces more, when the additional units will have the same costs as the previous units. So in this one, the business produces more but does not incur additional costs. Now I want to show you this concept in a graph called the scale of production graph. This is the scale of production graph. Look at this graph now. On your horizontal, we have our output as usual, which is Q, and on the vertical we have our cost. Now specifically this long run, this is the long run average total cost. We call it LATC. It's the long run average total cost. Now the long run average total cost, as you can see, it's made up of the small, quite a number of short run average total cost, number 1, number 2, number 3, number 4, number 5. So the short run, that S stands for short run average total cost. So all of them together, those small short run average total cost, they will in the long run give us what we call the long run average total cost, you see. But now remember the concept, economies of scale. What is happening to the average cost? The average costs are declining. You see, they are declining. Let's look at this solid bolded line. The average total costs are declining. And when that happens, we're saying the business is experiencing what we call economies of scale. Why? Because the average costs are declining. See, the average costs are falling as the costs are now divided, or they are spread over more units of inputs now. And then the second one, in between, here, from here to here, what happens to the average cost? The average costs are exactly the same from one unit produced to the next. It doesn't add when you produce from here, from this point to this point. You're getting exactly the same average cost. There is no extra addition of the cost. We call this constant returns to scale. So when the average cost decreases, because we are spreading our average cost on more factor inputs, we are experiencing an economy of scale. And then when the average cost remains the same from one production unit to another, we're saying the business experiencing constant return to scale. But from the constant returns to scale, what happens to the average cost? Can you see? The average costs are increasing and making it more expensive to produce more units. Every extra unit that we produce will cost us more, will become more expensive. So that's because the average revenue is increasing. So when this happens, when the average revenue, when the average cost increases, we're saying the business is experiencing what we call diseconomies of scale, right? So that's the difference between economies of scale, constant returns to scale, when we get exactly the same average cost, when we produce extra, and then when the average cost increases every time we produce extra, we are experiencing diseconomies of scale. When we produce extra and our average costs are decreasing, we are experiencing economies of scale. Right. Now we have come to the end of our presentation. In summary, what have we done today? We have looked at both the short run costs and the long run costs. Some of the long run costs that the business experiences in the short term, which is a period where at least one of the factors of production that the business is using is fixed. So some of those costs are your variable cost, your fixed cost, your average cost, your average fixed cost, average variable cost, as well as your marginal cost. So those 6 types of costs, they all occur in the short run, where at least we have one factor that is fixed there. That's why we're having fixed cost in our cost schedule. Right. Example of fixed costs are the rental on the building, the insurance premium that you're paying for some of the equipment in a business. Right. Those are examples of fixed costs. Variable costs are costs that changes with input. What examples do we have? If you your water and electricity account, it changes every month. The more we produce, the more water and electricity we are going to use, right? And the more laborers we employ, the more we are going to spend on the wages. I'm sorry for that. So those are examples of variable cost. And you must know how to calculate the average cost. Your average cost is calculated by looking at your total cost divided by your quantity. Or your average fixed cost is calculated by dividing your fixed cost by the quantity. Your average variable cost is calculated by dividing your variable cost by quantity. Whereas your marginal cost, which is the last one, how do we calculate the marginal cost? We use the formula. We say marginal cost equals to change in total cost divided by change in output from one production unit to the next production unit. That's how we calculate our marginal cost. So all this, we've looked at the different curves, cost curves in the short run. And very important cost curves that we have looked at is the fixed cost, which is more horizontal because the fixed cost remains the same. And then we have looked at the variable cost. You saw that the variable cost rises at a slow rate, and then it will start to decrease ultimately. So that is your variable cost. And then you have the total cost, which is made up of the fixed cost and the variable cost. You can see it is just above the variable cost. And then we have also looked at the average cost curve. We have looked at the average variable curve, and we have also looked at the marginal cost curve. The marginal cost curve cuts both the average cost curve and the average variable cost from their minimum point, from underneath. You've seen all that. And then lastly, we have also looked at the long run costs. The long run costs, here we are basically looking at the average costs in the long run, right? And working from a point of departure that says every business would like to see itself expanding in the long run and becoming bigger than it used to be. So they are creating more space to produce more. And when that happens in the business, then all the factors that the business is using in its operation will be variable. So in the long run, we don't have any of the factors that are used by the business that is fixed. All of them are variable. That's why we are accommodating the capacity of the business to produce more. But now, the business will have to look at its average costs. When the average cost of the business are decreasing, like we're having here on the screen, when they are decreasing every time we produce extra, that is good for the business. We say the business is experiencing what we call economies of scale. And the second period is also not bad. When the average cost remain exactly the same from one production unit to the other, it is also not bad, because we are experiencing a constant returns to scale. But the problem will arise immediately when the average cost are increasing every time we produce extra. That's a problem, because the business will be experiencing a diseconomies of scale. So this is where I would like to end my presentation, and thank you for your attention, and wish you everything of the best in your oncoming exam. Good luck to all of you. Thank you.